All right, so we're back, ready for more derivatives. So this time we're going to take a more in-depth look at the derivatives we were looking at last week. Last week was meant to be a survey, and so now we're going to take a slightly more deep look, especially with the pricing of these securities. That's really where a lot of the math gets involved, not so much the strategies for using them for hedging or trading. It's really the pricing models that get a little bit quantitative, especially with options. And we'll spend a lot of time talking about option pricing models as we go along. But even with the basic derivatives like forward and futures contracts and swaps, the pricing can be fairly complicated. So we'll start by looking at, once again, the properties of forwards and futures, which we've already seen. But now we're going to start looking at how to price or calculate the forward price of an asset. Maybe take a little more in-depth look at how futures contracts are marked to market, understand why futures prices converge to spot prices at maturity. And in the process, by the way, we're going to be introduced to an incredibly important concept in the derivatives markets, which is called arbitrage. So we'll be looking at that in a bit. Understand how forward and futures prices are related to each other, and then spend some time looking at hedging strategies with futures contracts. You might recall from last time that futures contracts are very standardized. So in other words, you can't just choose whatever you want. You usually have to take whatever is available. And so because of that, any given futures contract is not likely to be exactly what you need for your own hedging strategy. So there are ways you have to work around this, but we'll see how that goes. First, let's just review what a forward contract is. And of course, this is simply a contract in which you can agree to buy or sell an asset at a specific date in the future where the price is agreed on today. Okay, so you're locking in the price at which you'll be allowed to buy or sell this asset at some point in the future. And because these contracts are completely flexible, they can be negotiated directly between the counterparties. You can, in principle, agree to anything you want. You can have, for example, the purchase date could be 6 months in the future, it could be 9 months, it could be some bizarre number of days like 154. It depends on what you need. And also the assets themselves, in principle, there's no limit to what kinds of assets you can buy or sell with a forward contract. Sorry, you might recall from last time we were looking at the currency futures that are available in the Chicago Mercantile Exchange website. And there really were only a handful. I mean, the major currency pairs are represented there, but the lesser used currencies may not have a futures contract available on them. So let's say you do a lot of business in South America, and you, in particular, you do a lot of business in Peru. Well, the Peruvian sol, as it's called, doesn't trade that much in world markets. And so because of that, you're not going to find any futures contracts written on it. But if you want to hedge your risk when you're doing business with Peru, you don't have to give up, because you can negotiate a forward contract with a bank maybe in Peru that enables you to lock in the price at which you buy Peruvian sols in the future. So despite the fact that there is no futures contract for the sol, you can certainly negotiate a forward contract on the sol. It's not difficult to do at all. I mean, of course, you have to find the right counterparty who is able to deliver the sols to you, but it certainly can be done. So forward contracts are completely flexible, which is one of the great features about them, but they're certainly not standardized. And again, they do introduce the risk of possibly default by the counterparty, which you do not have to worry about with futures contracts. So, depending on your circumstances, you may choose a forward contract for your hedging needs. You might choose a futures contracts. There's a lot of considerations there, but what's important is both of them have their place. In other words, if one of these two contracts was clearly superior to the other, then one of them would just disappear from the marketplace. And in fact, interestingly enough, there are many derivatives that have disappeared over the years because they never were very well designed in the first place. They were never something that the market really wanted, or in some cases, they became obsolete. In a way, it kind of reminded me of when I first was thinking about this. like a species almost. Many species have died out over the millennia. And the derivative contracts have come and gone as well. And the ones that we still have now are the ones that clearly have stood the test of time, in the sense that there's many people who need them and find them very valuable and are willing to pay for them, or at least negotiate and enter into one. Well, anyway, so how do you calculate a forward price? So this is the first time we're going to be looking at a pricing model. In principle, any asset can be purchased for future delivery. The price that you're actually agreeing to is called a forward price. To distinguish it from, let me make a note of this here somewhere, a spot price. So a spot price is the price paid for an asset that will be delivered immediately. Now, the word immediately doesn't necessarily mean right this second. For example, in the currency markets, a spot price refers to any transaction where you will receive the currency within 2 days, 2 business days. A forward price is the price paid, of course, for an asset that will be delivered in the future. Okay, so in other words, anything beyond the immediate future, like I said, 2 days with currencies, is defined as a forward price. So for example, I might arrange a contract with a bank in which I agree to take delivery of British pounds in 3 months. The price that I'm agreeing to is actually a forward price, because the pounds will not actually be delivered for 3 months. And at that time, I will pay the forward price for those pounds. So now there's several different situations or several different kinds of assets that we can buy with a forward contract. So we need a few different pricing models. First of all, if we are buying an asset for future delivery where the asset itself does not provide any income to the owner, then the model is very simple. Okay, so let's take a look at what this model is telling us. By the way, these formulas often have time subscripts attached to them. And here, these 2 subscripts represent time, and normally time 0 means today. So in other words, F0 is meant to indicate today's forward price. And S0 is the current spot price, the price that you see today. Now, this E, if you haven't seen it before, is a constant, which we'll get a lot of use out of in this course. It's approximately equal to 2.71828, and we often see it used, especially when interest rates are involved, to calculate the future value of some type of investment. Now, we don't have to use E. There are other ways we could express this formula, but the book that we're using, John Hull's book, Hull seems to really love these types of models. Let me just take a little brief detour here for a second, just to explain this a little better. An interest rate can be compounded multiple times per year, which means the number of times per year that interest is paid. So for example, if a bank pays a 6% rate of interest, but compounded monthly, this means that your account is credited with 1/12 of that, sorry, 0.5% each month. In other words, instead of waiting to the end of the year to provide you with interest based on your balance, every month you're being credited with 1/12 of the annual rate of interest. In other words, 6% divided by 12 is 0.5% per month. So we say that the interest is compounded monthly. Now, in practice, in the United States at least, interest tends to be compounded on a daily basis, at least for traditional bank accounts. Like if you go to borrow money from a bank to buy a car, for example, and you read the fine print on the contract that you're signing, you'll see most likely that the interest is being compounded on a daily basis. For other types of situations, Not necessarily, but that is the common practice, at least for bank loans or for deposits in a bank account. For example, if you have a CD of some kind or certificate of deposit. Now, what's interesting about this is that the compounding frequency can continue in principle until we reach a maximum value. And so if the compounding frequency continues to increase, it eventually converges to infinity. Although in practice, you're not likely to see this, but it's possible to imagine this happening, which means that interest is compounded at every instant in time. Now, you might think that that would mean that we're earning a ton of interest, but it doesn't actually work out that way. So when this happens, we say that interest is compounded continuously. For any other compounding frequency, we say that interest is compounded discretely. So when you're calculating, let's say the future value of the sun, let me just show you an example here. Suppose that a bank pays 6% compounded monthly on its savings accounts. Okay, so what that means then is that if $1,000 is deposited in this account for 1 year, at the end of the year, the balance in the account will be, so what ends up happening is that you've got 0.5% each month for 12 months. So your future value, as it's called, is 1,000 times 1 plus 0.5% raised to the 12th power. Let me fix that real fast. It's kind of awkward to do superscripts in PowerPoint. And so that turns out to be about, rounded to dollars and cents, 1,000. Oh man, that doesn't sound right. No, I knew I did something wrong. $1,061.68, let's say. Okay, so in other words, I put $1,000 in the bank for a year. The bank is promising to pay me 6% compounded monthly. When the year's over, I'll have $1,061.68 in that bank account. So I just want to point out too, that if the interest had been compounded just once a year, compounded annually or paid once per year, then the balance would have been, and there would have been 1.06 to the first power times 1,000, which is just $1,060. Okay. So why is there more money this time? Why do we have more in our account? Whoops. So in other words, instead of 1061.68, we've got 1,060. So this is an important example, because what this means then is that we can see very clearly that we started out with $1,000. The initial deposit is $1,000. This is known as the principal. Okay. When you either borrow or lend money, it's called the principal. When interest is compounded annually, the interest earned is $60. This is known as simple interest because it is based on the deposited principal. When interest is compounded monthly, the interest earned is 6168, of which $60 is simple interest, and the remaining $1.68 is compound interest. So that extra $1.68 is a result of the compounding frequency being higher than 1. So we call that compound interest because what that reflects is that each time you get interest during the year, you're getting interest based on some of the principal, but also some of the interest you've earned up to that point in the year. Okay, so in other words, the compound interest is interest earned on previously earned interest. Okay, so most of the time, because the banks, like I said, compound interest on a daily basis, most of the time when you earn interest, some of it is simple and the rest is compound interest. Okay, so we always have to be aware of that there's two types of interest that we can earn or pay if we're borrowing. We have the simple interest, which is the interest on the original principal only. And then whatever's left over, if we earn more than that, is the compound interest, in this case, $1.68. Okay, now let me just quickly show you how this works. Maybe I'll use Excel for this because it's a little bit messy. Let's say that I've got 12 months. And I'll just add a couple of details in the top. The principal is 1,000. The interest is 6%, but the compounding frequency is 12 times a year or monthly. So I'll put it at 12 to indicate that is 12 times per year. So for each month, now 0 is month, the initial month, we start out with $1,000. After 1 month, how much do I have in this bank account? Well, my original 1,000 is multiplied by 1 plus. And I'll take my 6% and divide it by 12 to indicate 0.5% per month. And that means at the end of the first month, I've got another $5 worth of interest. Then at the end of year 2, month 2 rather, oh, okay. So what's, oh, wait a minute. To make one little change here. So at the end of month 2, oh, by the way, I better show this to dollars and cents because otherwise you won't get what's going on. Oh, yes, absolutely. If you want this, I'll save it right now because it's obviously very helpful. So we make sure that it doesn't get lost. This is, yeah. This is what's good about being online. I can just throw all these examples up there and save them. That's the thing. When you're in person, you can't save everything. Let me just make sure it gets into week 2. I'll call it compound interest example. Okay, so yeah, I want you to see the dollars and cents because otherwise you'll lose sight of what's going on. Now, what I'm going to do here is keep this going until the end of the 12 months. So I can just drag this down to 12. Whoops, 2 more. And there's the 1061.68. So this is the long way of calculating this. And so what's happened here is that during the first month, I only earned simple interest. So in fact, you know what, let's do this. The simple interest is only based on the principal. So it's going to be $1,000 times the 6% divided by 12. So every month I'm earning $5 worth of simple interest. And the total is going to be at the end 65. Wait, that can't be right. Oh no, it would have been 0. Sorry, it's 0 here. Okay, great. It's 60. Now, here, what I have to do is figure out how much is of this interest I see over here is compound. So in other words, I'm going to take this actual balance minus the original principal minus the simple interest. And so here, there's nothing left. Okay, it's just 0. So the compound interest is 0. I don't know why it's insisting that that be red. Oh, that's better. Huh, that's weird. All right, I'll make them all a number. That's fine. Okay, so the simple interest, this is the starting point. We actually should just put the asterisk here, I guess. Now, if I drag this down though, oh, wait a minute. Oh, I know what I should have done. Oh, wait a minute. No, I have a much easier. This doesn't have to be this hard. Hold on a second. Okay, I finally got it straight. Yeah, this is the compound interest. So basically, you know what I probably should do? Nah, it should be okay. All right, anyway, so the bottom line here is that each month we're getting $5 worth of simple interest, of which now the next month we get that extra 2 cents in there. Now, where did that come from? Because during month 2, the interest rate is being applied not just to the original $1,000, but to the $1,005 for month one. So that 2 cents is the interest on that last $5 in month one. And then here, this 5 cents is based on the difference, the extra interest that I have here. In other words, $10.03. So in other words, whatever I have in this account above and beyond the original principal, the interest that's based on that is what we mean by compound interest. Okay, so when we're done, you can see that they add up as we expected. We earned altogether $60 worth of simple interest and $1.68 worth of compound interest, because at the end of the year, we've got our $1,000 back. We've got 12 $5 payments of simple interest, and whatever's left over is our compound interest. Now, what's important about this is that as the compounding frequency increases, the simple interest never changes, but the compound interest increases, so that the total interest also increases. Okay, so now it may not seem like a lot, by the way, $1.68 versus $60. But if you leave the money in this bank account long enough, eventually the simple interest, the compound interest will be worth more than the simple interest. You can see that the simple is always 5. The compound interest increases. So if you wanted to know how long that would take, you could actually just drag it down. In fact, let's do that. Let's go on to the next sheet. And let's see how long I have to keep dragging this thing down to get to the point where the simple interest is less than the compound interest. Okay, so let's see. They were equal to each other right here in month 140, which means about 11 years from now, this compound interest will be worth about the same as the simple, and then afterwards, the compound interest will be worth more. And so if you take this further to, let's say, I guess we can stop at month 180. If I add these up now, after 15 years, well, the total is still higher for the simple interest, but the monthly amount that we're earning is higher for simple than compound interest. So the simple interest is growing at a linear rate, but the compound interest is growing at what's called an exponential rate. So in other words, if you were to plot this out, simple interest just continues to grow. It's a straight line, well, it's supposed to be. The compound interest starts out very small, but then it catches up, and when it does, it starts to exceed the simple interest. Okay. So ultimately, what really determines the compound interest is the compounding frequency. So, in fact, if you ever got a new credit card in the mail and you look at the documentation that comes with it, you'll notice that there's a big spread between how much simple interest you're paying and the compound interest. Because when a rate is very high to start with, the compound interest grows more quickly than it does when the rate is very low. So what this is all about is that the amount of money we have in our bank at the end of this period The balance in the account at the end of the time horizon is known as the future value of a sum. Okay, so we would use the terminology future value to tell us how much is this $1,000 going to be worth at the end of the year. And the answer to that question is here, $1,061.68. The future value will increase, I should say, as the compounding frequency increases. So in other words, if I were to change this to daily, you would see that at the end of the year, I'd still have $60 worth of simple interest, but I would also have more compound interest. By the way, if you want to know how much that would be, what you could do is use Excel's functionality. You could go down here and say, for example, and you can change this any way you like. Whoops. Let me just show you real fast so that you don't have to go through this entire chart every time. You could tell Excel, well, listen, I need to figure out the future value of the sum. So I'll ask it for the future value function, and it asks me for the rate, which is here, but it has to be divided by 12, because in other words, what it really wants to know is what is the monthly. Oh, you know what I just realized? Sorry, I'm missing something. This is a 1-year investment. Okay, now we're ready. So future value needs to know, now the rate is the monthly rate, because this is a monthly compounding. So I have to divide this by 12. The number of periods, on the other hand, is 12 months, not 1 year. There's no payment. That would imply a repeated payment. Now, the amount of money that we're investing is right here. It's $1,000. That's your principal. Now, it came out negative because it thinks that we're borrowing this money. What you can do is go back and change the PV, or present value, to a negative value, because that money is actually coming out of your pocket when you put it in the bank, and it comes back at the end. So the future value is indeed $1,061.68, as we showed. But now, because we're interested, let's find out how much of a difference it makes to increase that compounding frequency by to daily. So I'm going to change this to 365. You can see it didn't really go up a whole lot, did it? About 15 cents. It's kind of disappointing. So the compounding frequency does increase the compound interest, but if you were to do this with many different frequencies and plot the results, what you would discover is that, let's get this out of the way. You would discover that the compound interest increases but it increases very quickly at first, and then it levels off pretty fast. Okay, so in other words, it goes up very quickly when you jump from, let's say, annual to semi-annual compounding, and then to quarterly, et cetera. But then it flattens out, and there's a limit to how far we can push this. So in other words, it's reaching towards this limiting value, which you'll never quite reach. And so what we're going to do here is note that in the limit, when the compounding frequency reaches infinity, and we are using continuous compounding, the future value is computed with the formula. And so instead of what we're used to seeing, we're going to have the principal times E, and then we're going to have the exponent will be R times T. So in other words, for this case up here, in fact, let me copy the data again so we can see it. So let's say this time, everything's the same except the compounding frequency is infinite. Okay, so what is the future value? It comes from this formula, and we in Excel we put equals 1,000 times EXP is what it's called in Excel, and the exponent is R, the interest rate, times the time, which is T. And so we end up with 1061.84, which, as you can see, is only a penny more than with daily compounding. So it's this dashed line represents what we call continuous compounding.
I'm sorry, what's the difference with that compounding?
A penny.
But so what type of compounding is that?
Oh,
sorry.
when you have an infinite number of periods, we call this continuous compounding.
Or more than 360 days, you mean?
No, and it has to be infinity. In other words, there's only one case that's known as continuous. Okay, continuous compounding, an infinite number of compounding periods per year.
Okay, so more than 360, like.
Well, no, it doesn't.
Infinite.
No, it's not enough. Like if you had 700 or 800, that's still considered to be discrete compounding.
Okay, so, okay.
This is discrete compounding because the number of compounding frequency periods.
But that infinity would be just a little more? That's so strange.
Yes.
I thought if it compounds like 1,000,000 times, then it would be a
You
lot
would
more.
think so. You would think so. That's why it sounds so strange. But the difference between daily and in this case, at least, between daily and continuous is 1 penny. Now, if we had this money in the bank for 10 or 20 years, the difference would be greater. I mean, you know, part of the reason why we're so close is because, first of all, it's only $1,000, and secondly, it's only a year. If I had changed it to 100 years and 10 or whatever, you'll see the difference is greater. But in this case, it's only a penny.
Can we see what happened in like 100 years?
Sure. We'll do this one for 100. This is the beauty of Excel. And down here, let me just split the screen so you can see them both at once. It still won't be a huge amount.
Wow.
So down here, I'll change it to 100. So it's about less than $200. It's a very trivial difference. But anyway, the reason why, so you can see what we're building up to is this formula for calculating forward prices. What you're actually doing here is you're calculating the future value of this spot price with continuous compounding. Okay, so right there, what you've got here is that it's the same formula, except that it's S0 instead of P. It's still a future value. So that's all it is. It's the future value of the price, the spot price, when interest rates are compounded continuously. I think there's a numerical example in here somewhere. Yeah, here it is. Here it is. So the reason why books like Hull's book like to do this. You often see continuous compounding used with derivatives models because continuously compounded interest rates have certain convenient mathematical properties with discretely compounded rates do not. So in other words, it's not that unusual to see these used with derivatives models. You may not see them all over the place, but with derivatives models, it's just typical standard practice to use continuously compounded rates, which, by the way, can be converted into any other frequency we need.
Sorry, quick question.
Mhm.
In the spreadsheet, there was a formula. If you scrolled up a little bit, FV, I think it was like FVRET.
This one, yes.
Yeah, sorry. Can you just break that down in terms of what those letters represent?
Oh, yes, yes, yes. Let me do that right now.
Sorry.
Yes, I'm clearing out some space as we speak.
Yeah, thank you very much. It's really helpful.
Okay. FV is future value of a sum, which is the same thing as saying, for example, future balance in a bank account. That would be an example of a future value. P is the principal, the amount invested. R is the annual rate of interest. And T is the time horizon for the investment in years.
So even though a derivative contract likely has an expiration, the interest would be considered continuous on what basis?
Well, all right, here's how, let me show you what this is all about. Let's try another. Let me show you. Suppose that a forward contract is written on gold. Okay. Contract lasts for 1 year, matures in 1 year, expires in 1 year. Let's call it that. And the spot price of gold is $1,500. What is the forward price of gold? Now, in the slides, the formula is this. Let's go get it. And like I said, I mean, this is just a future value formula. In spite of the way it looks, this is really just saying you calculate the future value of that sum. In this case, the gold price. Now, suppose you were told the annual rate of interest is 5%. Then F equals 1,500 times. Oh, all right. Sorry. Wait. If the annual rate is 5%. Now, in principle, then the future value is, let's put it this way. So using Excel, future value, which in Excel would be used with FV formula, and you would tell it The rate is 5. The number of periods is what did it do? Is 1. There's no payment. The present value is $1,000. 50. Sorry, it was 1,500 for gold. Okay. The future value with annual compounding is 1,575. So what the derivative model is saying is this. What is the equivalent continuously compounded rate that produces the same future value? So in other words, we've got 1 plus 1,500 times 1 plus the rate of interest if you were to use the continuously compounded formula, you would have 1,500 e to the r times 1 and so then what you could do is say e to the r equals 1,575 over 1,500. Oh, sorry, I wrote it wrong. And that worked out to be $1.05. Now what you're going to do is take the natural log of those sides. And that works out to be 0.04879. So now the future value, and let me just split the screen again. Becomes so 1,500 E, and then using this continuously compounded rate, if you plug that into your calculator, you'll see that it ends up being the same thing.
What is this? What's on 20B in?
What is that?
20B. What's on that cell? Is this IN?
Oh no, ln, that's the natural logarithm. That's the log with base E. It's on your calculator.
Okay.
So anyway, what have we just demonstrated here? An annual rate of 5% is equivalent to a continuously compounded rate of 4.879%, because both provide us with the same future value of a sum. In other words, if a bank offered 5% compounded annually, and 4.879% compounded continuously. You would be indifferent between them because they provide the same future value. So in other words, in this model that we're using, you could use this approach, and this would be the continuously compounded rate. Which is what Hull likes to do in his book. But you could have also done this. Where this is the discretely compounded rate. Because they'll give you the same results, okay? It's just that in the first case, the R is health is continuously compounded. In the second case, in our example, it would be the annually compounded rate. They're both going to give us the same thing, but there are reasons why this is the preferred approach. Now, if you want, I can show it one of the reasons why this is happening. Why are we using the one on the left instead of the right? When the one on the right is what you might be more likely to run into in the real world. Why would we put ourselves through this trouble of using continuously compounded rates when they aren't really used in practice? Well, I'll show you briefly with an example why you might prefer continuously compounded rates. It's a very simple example. Suppose that an investor buys a stock at 100 and sells it 2 days later. Okay. Now, here's the price. What happened to the price? Okay. Starts at 100, goes up to 110, goes back to 100. Fine. So if I'm calculating the rate of return in discrete terms, how do I figure that out? Here I've got the ratio of 110 over 100 minus 1, 10%. The second day, I've got the ratio of this number to this number minus 1. And that's a loss of 9.9%. If I use continuous compounding, I'm taking the natural log of this ratio, 9.53%. And then the next day I take the natural log of this ratio, negative 9.53%. Now here's the thing. How much did I actually earn from the stock? Nothing. But if I add up these daily returns, what happened? With the discrete compounding, it appears that I've made 0.91% and I've done no such thing. Whereas with the continuous compounding, I've broken even. So you can see the problem with the discrete compounding is that it introduces a bias, an upward bias into our returns. And that is one of the reasons why, at least with derivatives models, it's usually preferred to use continuous compounding rather than discrete compounding.
I'm sorry, how do you go from 100 to 110?
How do we get what?
Also, the stock price on year 0 was 100.
Right.
And then the stock market made it to 110.
Right.
And then it went down again to 100.
That's right.
Oh, okay.
Yeah, it just went up and then down to the same spot. So I sell it 2 days later. I know that I broke even, but if I use continuous discrete compounding to measure my returns, it appears that I've made money when I really haven't. So you can see that, you know, this is an extreme example, but still you can see you're not going to have this problem with the continuous compounding. But with the discrete compounding, the reason why this is happening is because each time I calculate the ratio, I'm starting from a different value of the stock. And that's going to affect the way these results are calculated. Whereas here, I don't have that issue. So this is meant to be a quick demonstration about why this shows that discretely compounded rates can be biased upward over time and give it the appearance of a higher return than we're actually getting. This is not a problem. With continuously compounded rates. And I think that's one reason why Hull uses them all the time, even when, you know, the thing is sometimes in the markets, the standard practice is to use, let's say, semi-annual compounding for certain types of situations, like with bonds, for example. We might see semi-annual compounding being used in the market. So Hull likes to use these continuous rates anyway. He tends, in my opinion, to overdo it a little, but you can see why he likes the continuous case. But you know, most derivatives models are actually based on continuous compounding. And it's all about convenience. We know that they don't exist they don't tend to be used in the real world. But like I said here, we know that both of these mean the same thing. 5% compounded annually, 4.879% compounded continuously. In principle, we can use either one of these to calculate the future value of the sun because it will give us the same results. But yet, with the continuous compounding, we also have the added advantage that we do not have to worry about that bias. So if we're looking at returns over a long period of time, that becomes a problem. Anyway, so what brought all this up is that this formula for the forward price of an asset is nothing but the future value of the spot price. Okay, in other words, if I invested this S dollars for T years at a continuously compounded rate R, that's what I end up with. Now, what's interesting about this, and this is something we haven't really addressed up to this point, is that if, and I'll only just briefly mention this now, if the actual price in a forward contract is different from the value obtained from this formula, and we'll call that the implied forward price, then the investor could earn what are called arbitrage profits at the expense of the counterparty to the contract. Now, we're going to see a lot of examples of this as we go along. But and I just want to briefly mention what arbitrage actually means, and because we're going to see it quite a bit. An arbitrage results when it is possible to simultaneously buy a relatively underpriced asset and sell a relatively overpriced asset. When that happens, then it becomes possible to earn risk-free profits by exploiting this mispricing of the asset. So let me just quickly show you an example of this in practice, a very simple one. We'll get to the more complicated ones later on. Let's just say that gold is selling for 1,500 per ounce in the US and 800 pounds per ounce in the UK. If the exchange rate is $2 per pound, then the gold price in the UK is equivalent to $1,600 per ounce. So you see what the problem here is, that the gold is actually undervalued in the United States and it's overvalued in the UK. So as a smart investor, what would you do? Well, assuming that this is possible, if you're a dealer, this shouldn't be a problem. An investor could then buy gold in the US for 1,500 per ounce and then resell it in the UK for 1,600 per ounce. Earn 100 per ounce profit. Now, of course, in practice, you would have to subtract the cost of shipping the gold overseas, but this is an arbitrage because it comes about because it is not priced correctly in the two countries. It's too cheap in one country and too expensive in the other. And so the spread between the two is a profit that should not exist, but we're able to get this profit because we notice that the price is too low in the US and too high in the UK. And so this is what we call an arbitrage profit. And in an efficient market, arbitrage profits should never exist in the first place. There's no way that that British dealer should have put that quote for gold out, given that the price is very different in the United States. And if he does, then investors will take advantage of it and take money out of his pocket and put it in their own pocket. So this is what we mean by arbitrage. And it turns out that the derivatives models we'll be developing are based on the premise that if they are violated in practice, investors could earn arbitrage profits. And by doing so, by the way, I just want to follow this up. Can this go on forever? No. What's going to happen if investors start doing this? Well, in the process of buying gold in the US, the price rises. As gold is sold in the UK, the price falls until the prices are equal in the two countries. That's it. And then the arbitrage will be gone. Now, in practice, what happens is you'll get hedge funds that are set up to look for these opportunities, but it's not human beings. Computers have been programmed to sift through enormous mountains of data and look for these temporary discrepancies in markets throughout the world. And when they see one, they're programmed to jump in and buy whatever's too cheap and sell whatever's too expensive. Now, in practice, these opportunities should disappear within fractions of a second. So computers have to do this in order to make money. It's gotten way beyond the point where human beings can do this because markets are just too efficient, but they're not perfectly efficient. So that's why these opportunities can still exist once in a while. So the hedge funds have their computers set up to look for them. Now, what hedge funds also do though, which is different now, what they do is they don't just buy and sell, things that are too cheap and too expensive. They also use an enormous amount of borrowed money to finance these transactions. So for them, the rates of return can be huge, but if they do it badly, if they miss somehow, they could also end up losing a ton of money because hedge funds are designed to be very risky. And so often the only way they can achieve that is to use borrowed money to finance their strategies. That way, if they're right, they'll earn a huge rate of return, but if they're wrong, they could really get clobbered. Okay. Anyway, so what brought all that up was this forward price model. And so we'll see later on that if you get a quote in the market that is different from this F0, that means you have the opportunity to earn arbitrage profits. And so because of that, you can rest assured that these models will almost never be violated in practice, because if they are, people can earn arbitrage profits, and by doing so, they force the prices back to their correct levels. So it's almost like gravity in physics. Arbitrage in the derivatives markets, it enforces these relationships. Okay, if they're violated at all, even for a fraction of a second, somebody's going to take advantage of it, and that will push the prices back to these correct levels. Okay, so all of the models we'll be seeing in this course are all, except maybe a few, are no arbitrage models, as they're called, because violations of these models would lead to the opportunity to earn arbitrage profits. But we'll show how to prove that they are, in fact, arbitrage-free models. You don't just have to take our word for it. You can prove or show what strategies you would follow if these models are violated. All right. All right, I think we got enough of the future value stuff here out of the way.
Are we gonna look at the homework?
Oh yeah, we're gonna do an example right now. So here's the formula for calculating the forward price. In this case, the forward price is for a stock that provides no dividends. Okay, now the stock is selling for $90 a share. Oh, one more thing. I just want to mention that the interest rate used here, I did not mention this yet. In these models, in our derivatives models, violations result in risk-free arbitrage profits. That being the case, the interest rates in these models are risk-free rates. And that means basically treasury rates of the same maturity. So for example, here in this case that we're about to look at, suppose you were told that the price of the stock is 90. The yield on it's a 3-month contract. Okay, 90 days. So the R would be the 90-day treasury bill yield, which we're assuming is 5% compounded continuously. So that being the case, and since it's a 3-month contract or a quarter of a year, that means that if I wanted to take delivery of the stock in 3 months, I would expect to pay $91.13 at that time. Okay, so I'm going to enter into a forward contract, which gives me the right to buy the stock in 30 days, or sorry, 3 months or 90 days for a price of $91.13. That is the implied forward price. Now, if the forward price quoted to me by a dealer is different from this, depending on whether their quote is too high or too low, I can replicate the cash flows to this contract and find a way to take advantage of this mispricing. So, and we'll do some examples of that later on, but right now I want to show you what would happen if instead the asset does provide some kind of an income to the owner. Now, this is often applied to bonds, where we know that if you own a bond, you're going to collect coupon payments. But if you buy a forward contract to take delivery of a bond, you're not going to earn those coupon payments until you actually take delivery. So in the meantime, you're actually losing interest by buying a forward contract instead of just directly buying the bond. So we have to take that into account with our formula. So what we're going to do here in this case is we're going to have the same thing as before, but minus I. And I is simply the present value of the future coupon payments. Now let's go back to our spreadsheet for a second. We have to go over this concept of present value. Up to this point, we talked extensively about the future value of a sum. If I put the money in the bank now, how much will it be worth in the future? So I can calculate the future value using Excel's formulas with discrete compounding. But if I have continuous compounding, I have to use this formula. Okay, Excel doesn't have the discrete case, the continuous case built into it. So the present value, let's go ahead here and discuss this right now. The present value of a sum refers to the amount that must be saved today to be worth a specific sum in the future. For example, if an investor wants to ensure that he or she has, I don't know, $25,000 in the bank in 2 years, how much must be saved today to reach this goal? Okay. Assuming that the interest rate is 5%, let's say compounded annually, just to keep it simple. All right, so we can use Excel's formula. We know that the amount we want to save is 25,000. That's our future value. So the future value is the sum we want to have in the future. The rate of interest is 5%. The time is 2 years. And let's say, just to keep it simple, the compounding frequency is once a year. There we go. Okay, so Excel can do this for us. The function is called PV, and the rate is 5%. Technically, we should divide it by 1, but it'll give us the same result. The number of periods is 2 years. There's no payment because that would imply that it is repeated. The future value that we're saving is 25,000. So that means that we would have to put 22,675.74 in the bank today to be worth 25,000 in 2 years. Okay, now we can think of the present value as how much the sum is worth today. For example, an investor should be indifferent between receiving 22,675.74 today and 25,000 in 2 years. because in present value terms, it's the same thing. All right. As another, well, all right. So it turns out that this is an awfully important idea because the value of all financial securities, not just derivatives, can be thought of as the present value of their future cash flows. So that's why this is so important. Now, if interest is compounded continuously, then the formula for PV is, and it's PVE, future value times E, and the exponent is not RT, but negative RT. So let's try this example again with continuous compounding. So we had all of this information. Except now this is infinity. What's the PV? Well, we'll use this formula up here. We have 25,000 times E. This is how Excel uses E. And then the exponent is minus R times T. And that's going to drop it down to 22,620. It's a little lower, not much. If you want to round it to dollars and cents, it's that 22,621. So the present value is lower with continuous compounding because the investor will earn more compound interest with continuous compounding and will therefore need to save less money to reach the same goal. Okay, so in other words, when you look at this formula, and this I is meant to be the present value of the interest payments on this bond. So let's look at this example for a second. A treasury bond will mature in 15 months. The bond pays a 5% coupon on an annual basis. The next coupon is due in 3 months. The bond's face value, the value at which it was issued, is $1,000, but it's currently selling for $1,020. So I'm going to move this diagram, by the way, to the next slide so you can really see it better. In my opinion. Okay, so in other words, we pay $1,020 for the bond today. In 3 months, we get a $50 coupon payment, and then 12 months later, we get the face value back plus another $50 coupon. So we pay today, receive a coupon, and then at the end, as you know with a bond, at the end you receive the last coupon plus the face value. Now, according to the timeline, the first $50 coupon appears in 3 months, and then the face value plus the coupon will come back to us in 15 months. Now, it says in the problem that there's 2 different relevant rates of interest. The 3-month rate of interest is 2.5% compounded continuously, and then the 15-month rate of interest is 3% compounded continuously. So how would you plug all this into that formula and come up with a forward price for this bond. All right, well, let's find out. First of all, what is the present value of that next cash flow? Okay. Oh, okay. The contract is meant to go for 6 months. Okay, that's an important detail because anything that happens after 6 months, we don't receive that cash flow. So the only one that's really relevant here is this $50, not this one. This is past the 6 months. So, you know what, let me just change this a little. Yes, the interest rate here is 3%. But in 6 months, the contract matures. So any remaining cash flows, we don't take them into account when we calculate the forward price of the bond. So here's what we're going to do. We'll calculate the present value of that next coupon payment that we will indeed receive. And here's that present value that I just mentioned. It's CE to the minus RT. C is the coupon of 50. The rate is 2.5%. And the time is a quarter of a year, 3 months. So that means in order to have a $50 coupon in 3 months, it is equivalent to having 49.6885 today. That gets plugged into my formula. We subtract that because remember, I'm not getting that cash flow as long as I own the forward contract. That reduces the value of the contract. On the other hand, the bond doesn't actually mature. For the contract is for 6 months. Okay. So in other words, this part tells me the value of the bond today. Its future value in 6 months when the contract matures is obtained by taking E to the RT, just like before, and then R is 3% per year, half a year in the futures when the contract matures. So in other words, if I want to take delivery of this bond in 6 months, I would have to agree to pay $984.9759 for it. Okay, so 6 month contract matures, that's when the bond is delivered. What is it worth at that time? All right. So it's, again, it's the same as what we had before, except this I is different. When there was no income, it was easy. It was just SE to the RT. Now, most assets do not provide cash flows in lumps like this. In other words, every 3 months. For most assets, the income can be treated as if it were continuously compounded. And again, this is only an approximation, but we can do it because it's a lot simpler and probably more accurate than doing it with discrete compounding or discrete cash flow. So what happens then, and you'll see this more than any of the other models, is that, remember before, it was F0 What's changed now is the exponent. Q is the yield of the asset. But again, it is assumed to be, for convenience, continuously compounded. Okay, continuously compounded. Okay, so when would you see something like this? Well, a classic example of this is in the currency markets. When you own a foreign currency, let's say I own British pounds, I can use them to earn the British pound rate of interest. But if I have a forward contract on the pound, I can't do that. So having a forward contract on the British pound is less attractive than actually owning the pounds, because if I own the pounds, I can earn that foreign rate of interest. Let's say I deposit them in a euro sterling bank account in London. or New York, whatever. So I'm going to subtract that Q from here. So let me show you a quick example right here. The spot exchange rate between the dollar and the pound is $1.80. The risk-free rates in the two countries are 3% for the US and 5% for the UK. What is the 6-month forward price for delivery of the pound? In other words, I'm an American importer and I want to buy pounds in 6 months. I want to lock in a price. What price am I locking in? Well, according to this formula, remember the US rate is here. This now becomes the UK rate. And T is just time. And this is the spot exchange rate. So if you plug in these, and it's only a 6-month contract. So we'll call that, think of that as the time to the delivery date or time to maturity. If you plug in the numbers, you'll see that the forward price is $1.78.2 per pound. So if I enter into this contract, the forward price would be 178.2. That's how much I can lock in for the price of buying or selling these pounds. Any other price would result in an arbitrage. So it has to be this number.
Can you go back to the previous slide?
Mm-hmm. And also keep in mind, we're assuming continuous compounding.
Okay, and if it's not continuous compounding, that was the homework, right?
The formula would be a little bit different. Let me show you what the formula would look like without continuous compounding. You would have this would be discrete compounding. So it could be done that way. Yes, it's just that Hull's book, like I said, Hull loves to do it with continuous compounding. But again, with the derivatives markets, often this is what you see anyway. Now, it turns out that if you've ever had a class in international finance, you might recognize that for the case of currencies, this relationship is often known as interest rate parity. You don't have to know that. I just want to throw that in there. If S is a currency, then this is known as interest rate parity. And because a lot of forward contracts are written on currencies, we hear, this is an important relationship. Now, what I've got here, no, we don't need to do that tonight if you don't want to. I can send you the answers. I don't think we have time to do that. But I mean, if you want to ask about it separately, we can certainly do that. Anyway, so we've got, I put together a nice little chart for you because these are really the three main cases you're likely to run into. The asset pays no income. It has a known income, which means a lump sum payment every so often, and then a yield, which means continuously compounded. You have to pick the one that makes the most sense, but those are your three basic forward pricing models. And they're all no arbitrage relationships, meaning that if they're violated, there will be opportunities for investors to earn arbitrage profits, which will push the prices back towards this level. All right, now futures contracts, we've already discussed this. We don't have to spend so much time talking about the differences, but we do want to understand how their prices are related to forward prices because they're not identical. The fact, especially that there's marking to market, is going to cause there to be a discrepancy between forward and futures prices. So in other words, if I enter into a forward contract to buy British pounds in 6 months, the price that I end up paying might be slightly different than if I enter into a futures contract on the Chicago Mercantile Exchange. There are some differences between them. So the prices will not necessarily match up with each other, but they won't be too far off either. So let's just briefly review the differences. Forward contracts are negotiated between counterparties in the over-the-counter market. Futures contracts are traded through organized exchanges like the Chicago Mercantile Exchange. Okay. Number two, forward contracts are negotiated with a counterparty. There's always a risk of default. Not so with the futures exchanges. They guarantee their performance of all of their contracts. And that's one of the big selling points. No credit risk. Now, having said that, when you negotiate a future forward contract, you're probably dealing with one of the largest investment banks. You're not dealing with some small bank out in the middle of nowhere. It could be, for example, Morgan Stanley. So you would think that would reduce the credit risk, but you never know. We have this notion of offset with the futures contracts. You can get out of your position by taking the exact opposite position in the same contract. With a forward contract, most likely you're going to wind up taking delivery or making delivery. All right. And of course, the marking to market. So I think we've already kind of talked about this. So we can kind of skip over some of this, but here, let's look at a marking to market example. An investor takes a long position in the September British pound futures contract, which is written on 62,500 pounds, and the futures price is $1.26 a pound. So I'm locking in the price at which I can buy or sell pounds at $1.26. Now, having said that, unlike the forward contract where I just wait till September and then buy the pounds, here there could be cash flows coming into or out of my pocket in the meantime based on my margin account. Now, let's just assume for simplicity that the initial margin that I have to put up is $16.50, and then the maintenance margin is $1,000, which means if the balance falls below that level, I have to bring my balance back not to $1,000, but to $16.50. Now, I have a long position, which means I'm buying pounds. And the contract, since it's written on 62,500 pounds, every change in the exchange rate by a penny changes the value of my position by $625. Now, keep in mind, too, if the balance of my account goes above the initial margin, I can actually take out the difference. Now, let's take a look at this chart. So we start out here. Now I'm in the long position, I'm buying, so I don't want the price to go down. So you can see here that the price went down by not even a penny. All right, so what happened here? It went down by 0.0051, which when you multiply by $625, let's see, I think I did that wrong. Oh, I multiply, no, the change is multiplied by 62,500 pounds. Okay, in other words, I lost 0.0051 cents per pound, but the contract is written on 62,500 pounds. I just lost $318.75. Now, the balance of my margin went down by that amount, but I didn't get a margin call. I don't have to put any money back just yet because I didn't fall below $1,000. Now, the next day, the price goes up. And this brings me all the way up to about 1868. Now, I could withdraw the surplus above and beyond 1650, but I choose not to do so. Okay. Good thing, too, because the next day, the price drops and I'm down to 1231.25. And then, guess what happens? The price falls so far, I'm dropping below 1,000. I have to return or restore the account to 1650. That will require a deposit of 706.25. So then the next day, the price goes to 125.90. Now, compared to the day before, That's an increase of about 1.03 cents, which when multiplied by 62,500 gives me a gain of about 643.75. So between this deposit and my profit of 643.75 today, when I add that to yesterday's balance, my new balance is 2293.75. And it will continue like that until I either unwind my position or I take delivery of the pounds. So I'm going to pay the price that exists at that time for the pounds, but I'll also have either a profit or a loss for my margin account. So the net effect of all this is that I'll ultimately pay $1.26 for that pound, those pounds.
All right,
All
that
right.
was the price per pound in dollars, right?
Yes, it's going to be $1.26,
Yeah.
including the changes in my margin account. Exactly.
And what was the 62,000 that you were multiplying?
Oh, the contract on the CME, let's
Oh,
go
yeah.
back. I have a picture of it right
It's a
here.
minimum required 62,500, right?
Yes, exactly. Each contract, God only knows how they came up with that number, by the way. 62,500, there it is, right on top. The contract, the size of the single contract is 62,000. You would think it would be something rounded, like 50,000 or 25,000. No, 62,500. Are they crazy? But that's what it is. You got to pick either that or nothing. Now, having said that, there are other exchanges where you can get smaller amounts. The Philadelphia Stock Exchange has smaller contracts if you want one. But in the Chicago Mercantile Exchange, that's all that we have to choose from. It's either that or nothing. Anyway, so let's see. I forgot where we left.
In the homework, it said like, so the future price, I'm sorry, the interest in the US was 1% and the interest in the UK was 2%.
Right.
I didn't understand that. So was that to confuse us? Because if we're buying,
No, because with that one, let's take a look at it.
no, that was assignment 1.
Oh, was it in one? Oh, okay.
Yeah.
No, I don't ever put anything in there just to confuse you. If it's in there, it's needed. Oh, this is you're just calculating the forward price.
Like, so in the question number 1, yeah, 1A, right?
Yeah.
It says the spot exchange rate between the dollar and the pound is 1.30 pounds. The 6-month US rate of interest is 1% and the 6-month UK rate of interest is 2%. So which one are we using? The 1%?
You need them both.
Oh, what is the forward exchange rate between the dollar and the pound? Oh, so
Yeah, you're using the forward price, the formula for the forward price to come up with that.
so which one is the formula for the forward price?
For the currencies, let me keep scrolling back. I'll find it. Here it is. This one.
Oh, but we didn't know that formula until today.
Oh, do we not? Oh, okay. Sorry about that. Well, then, you know what? I'll tell you what, you can hand this in next week if you need to. Did I really blow it like that? Sorry. I thought we covered it last week, but maybe not. That's all right. You can have extra time then, because it's definitely this formula right here.
Hey, Alan, quick question on the submission of homeworks. Is sending it to you by email the best way to do it? Or is there
Yes, I would definitely recommend email. Now, I'm still fooling with Brightspace, and don't worry, I'll get it straightened out. But for the time being, and even when I get it set up, you might want to think about emailing it to me, because you never know what can happen with technology.
Should we know where the Brightspace link is?
The thing is, they just started using it like last summer, maybe. I don't remember any longer, but I don't remember.
But we can email you,
When you
basically.
yes, you can always email.
Okay.
If you log into your account, it's supposed to be one of these apps that they, I guess, have that theoretically you should see it. But again, I don't know how that works. It's
We don't see your class.
no, I'm still trying to get it set up. I looked at it and I was thinking, oh, this looks, and I realized I have no idea how to set it up. So I have to, because now I have to call them up, I have to get somebody on the phone and I have to fool around with it. And that's what's holding it up. It's just, when I get a minute to actually do this, I will. But in the meantime, you can always
Email works
use,
fine if it works fine for you. I just want to make sure
yeah.
following protocol
Mhm.
based on your guidance.
Yeah, and also my the videos are on YouTube. Let's go find them.
Yeah, I found it.
Oh, okay, good. It wasn't
I put
annoying.
I put the name and there's a lot of other people with names.
And you should go to playlists because, I mean, they're all listed separately, my videos, but it's probably going to be easier to find it in my playlist. There we are, Derivative Spring 22. So just go in there and then you can download it, or I guess watch it at where it is. And it just comes right up. So that's that. But yeah, I'm pushing hard to get myself into Brightspace, but because it requires some technical expertise from the school, that's what keeps holding it up. If I could just open it up and just know how to use it automatically, I would. But I have to get a hold of them and say, hey, you know what? I'm not seeing what's happening here. So that's why it's taking so long. But yeah, so let's see, where do we leave off?
Can we do an example like the one in the homework?
An example of what?
The question number 1A,
Oh,
using the phone.
yeah, like if you
That's number 2.
let's say, for example, I told you that the spot exchange rate between the dollar and the pound is it, let's just say $1.50 per pound. The US rate, it's actually the risk-free rate. It's 3%, and the UK risk-free rate is 4%. What is the implied 3-month forward exchange rate? Now, the thing is about these forward contracts is they often, but not always, have increments of every 3 months. In other words, there's a 3, 6, 9 month forward exchange rate, which you see happening quite often. Now, the formula, remember, is so S0 is $1.50. R is 0.03. Q is 0.04. T is 3 months, which is a quarter of a year.
What does G mean?
Time.
Oh, G means time?
Yes. So therefore, F0, today's forward exchange rate would be 150. E, and in the parentheses, you have 0.03 minus 0.04. Okay. Now, what you should probably do is solve for the exponent first. And that's going to be negative 0.0025.
Sorry, Professor Anderson, on G, you said it's time,
Mhm.
but sorry, it reads like it's the UK risk-free rate of 0.04. Just trying to figure out what the 0.04 is coming from.
Yeah,
Oh, Q is the UK rate.
Oh, my apologies. Okay, so Q, okay, G, Q is the UK rate, R is the US rate.
That's right.
so
Un-
what does Q stands for? Like Q?
In this example, it's the UK rate. It's actually in general the foreign rate of interest. R is the US rate. Q is the foreign. Yeah, like this could be the dollar and the euro, for example, or it could be the dollar and the the Swiss franc. It could be anything. So Q is the foreign rate. It just so happens to be the pound in this case. Now, if you go to your calculator and you find the e to the x button, e raised to the minus 0.0025 is approximately 0.9975. So you're going to wind up with about 149.63, let's say. This is with rounding.
I'm sorry, you said that E was in Excel?
It's in Excel, and it's also, if you have a calculator.
I don't have a computer.
Oh, all right. I'll show it to you in Excel. Hold on. Yeah, Excel can do anything. All right, so let's copy this into Excel now. So we'll gather up all the useful details. So the spot exchange rate, which is S. $1.50. The US rate is 3. The UK rate is 4. The time in years is 0.25. In other words, 3 months. Okay, so what you're going to do I'll add these two so you can see better. So F equals SE. Okay. Oh, this is the same file. I'm going to keep everything. I know it says compound interest examples, but maybe I'll rename it tonight's examples or something like that. Everything, if you see, I've got all these sheets here. I've just
All the
kept
tabs.
everything.
Got it.
Yeah, this is still the same sheet, so don't worry. We will definitely have this available to you, so you won't miss anything.
Thanks for doing that.
Sure, no problem. Over the years, I've always end up using Excel for everything, especially on online classes, because it's so useful. It's easy to put all the information in here that you need, and you can just look at the formulas and you'll say, "Oh, I see what you did." Plus, I always encourage people to learn as much Excel as they can. So you'll have S times the Excel function for E is EXP, by the way, and then you're going to put in the exponent, which is R. Oh, you have to watch it with this. R minus Q is being multiplied by T. Okay, so you see what I had to do. I probably didn't need all those parentheses, but I know it'll work. And voila.
Sorry,
There's our result.
E is EXP?
Yes, it's spelled EXP in Excel.
Oh. And how come there's no exponent in there?
Well, there is, but it's in the parentheses.
Oh.
You see where I've got, actually, let me show, no, that's not how, I don't know why that keeps happening. There we go. There is an exponent, but it's in parentheses. So what you're seeing in the parentheses is the exponent for E. By the way, if we don't get through all this material tonight, we have a certain amount of flexibility. We can spill over into next week if we have to. I mean, ideally, we'd cover one topic each week, but sometimes it doesn't work out. So, you know, it's okay. And also with the homeworks, if that happens again, like if I ask a question that we haven't covered yet, just remind me, and then, you know, you can have an extra week to do it. You know, this is not meant to be a rigid class by any means, okay?
I already sent you the homework, so.
That's right. If you want to send me an updated version of it, go right ahead. But in your email, remind me that it's this, you sent me an updated version, so I know which one to look at. Okay, not a problem. Okay, this is not the Army. All right. All right, so that's how that would work. So, I mean, we could do them all in here if you want in Excel. You don't have to use a calculator. But if you do, I recommend very strongly the TI-84 series because they're so powerful. You may have used those in college. I noticed that when I teach this in college, a lot of the college students were required to use it in high school. But they've only been, you know, out of high school, they've only been in a high school a few years. But yes, I mean, it's a very different experience with the full-time college students because any world events that happened before 2019, they're not going to have any idea what you're talking about.
I was going to say, you know, for the 20 plus year, you know, audience that hasn't been in high school in that long.
Right. That's right. You probably were in high school before they were born. I mean,
Yeah.
it's like I said, it's a very different audience. So you know, I just avoid mentioning, you know, I would never say to them, like, do you remember like, and some event that happened even 5 years ago, I would just tell them about it. And, you know, or mention movies that came out 20 years ago. No. Okay.
Yeah.
Because, well, their experience is so tight. I mean, most of that time they were children. And so their experience as adults is extremely limited. So anyway, but on the other hand, they remember what they learned in high school very well because it was so recently. And so that's a huge edge they have. Plus, they're on top of the technology like you wouldn't believe. So they have their advantages too. It's just that, you know, if I were teaching history, I might have a different experience with them. But since they're so good with the technology and their math skills are really good, so it's a very different, you know, experience with them. But anyway, oh yes. So that's how that works. So so this next part is more of a theoretical discussion about these forwards and futures prices. I'll tell you what, since and then we have to talk about correlation too. Why don't we? There's a discussion here about hedging strategies, which is kind of interesting. Oh, I didn't even realize it. I was terrified that we were going to run out of time tonight. No, we're good. We're ahead of where we need to be. I didn't even notice it. You know why? Because tonight we're only doing an intensive review of, it looks like forwards and futures. It looks like next week we'll be looking at swaps in very great detail. That's it. That's how this is going to work. And then options is the week after. So no, I really was scared that we're going to run out of time. I don't think so now. I think we're good, but I think we do need to have our break before it gets too late. We're going to look at a theoretical discussion about forwards and futures prices, and then we're going to look at some hedging strategies, okay, which I think you'll find very interesting. All right, so let's knock it off for our usual evening break, and then I will finish this up, okay? All right, see you all in a bit. All right, I guess we'll pick it up again right here. So we're going to see how and why spot and futures prices have to be the same on the date of delivery to avoid an arbitrage. So this is a good example of how an arbitrage can be exploited. And essentially, remember, what we're trying to do is buy something that's too cheap and sell something that's too expensive. And sometimes it's not obvious how to do this, but suppose the way we can prove that F must equal S on the maturity date is to show that if not, there'd be arbitrage opportunities, which would cause the prices to move back to this level. So we'll start with the example of F being too low. Now, if F is too low, remember, we're buying whatever is underpriced and selling whatever is overpriced. So we buy F by entering into a long futures contract to buy the asset at a price FT. We then take delivery of the asset, sell it at the price ST, the spot price, and we make a profit. Not a problem. Now, if F is too high, then we buy S, we enter into a short futures contract to deliver the asset for the price FT. We deliver the asset and collect FT, and we end up with a profit of FT minus ST, which is positive. Any way you look at it, if they're not equal to each other, then we end up with the same price, because after the arbitrages take place, the prices switch until this is what happens. Yes, here it is. This is what we're really building up to. The relationship between forward and futures prices, there's no guarantee that they'll be equal to each other because of the marking to market process. That throws it off a little bit. So the question is, how and why is this happening? Well, it turns out that the relationship between the futures and the forward price depend on the asset underlying these contracts and how closely it is correlated with interest rates. So just as a quick reminder, this is the symbol for correlation. This is the Greek letter rho, as it turns out. And it represents the correlation. A positive correlation simply means that two variables tend to move in the same direction. Like in this plot that we're seeing here, the scatter plot, you can see there's a strong tendency for X and Y to move in the same direction because this trend line between them has a positive slope. We say that X and Y are positively correlated. In the next graph, they're negatively correlated because they tend to go in opposite directions. And then in the third case, they're unrelated to each other or uncorrelated, meaning that there's no connection between them. So if the correlation between the underlying asset and interest rates is positive, when rates go up, you will find yourself earning a positive margin balance, which you can withdraw and invest it at a relatively high rate of interest. If you find that rates are dropping and you're losing money, you can borrow the money you need for your margin account at a relatively low rate of interest. So this means that it's advantageous to have a futures contract compared with a forward contract. If it's the other way around, with negative correlation, this is not good because, when rates go up, you lose money and you have to finance the margin payments at a high rate of interest. And if rates are dropping, you're making money at a time when your reinvestment income will be very low. So the bottom line is that what you're seeing here, when we have an underlying asset that's positively correlated with interest rates, the futures price will be higher than the forward price. With a negative correlation, it'll be the other way around. With no correlation, they should in principle be equal to each other. All right, now here's the one that we want to study for a bit. How do you hedge with a futures contract? A forward contract couldn't be any simpler because you can customize it to exactly what you need, but not so with the futures contracts. Futures contracts cannot be customized. There's only a certain number that are available and they all require marking to market. So hedging with futures contracts is more challenging than it is with forward contracts. But the big advantage is that with futures contracts, since we can unwind them, we don't really ever have to take or make delivery of the asset, whereas with a forward contract, you really do. So if you really and truly do not want to have to worry about that, then you're probably better off with a futures contract, in spite of all of the problems. Okay, now, first of all, if we have trouble finding the right contract, then we can think about correlation. For example, what if I do a lot of business in Iceland? Small country, the krona, the name of their currency is the krona. You're not going to find futures contracts in the krona because it isn't that heavily traded in the international markets. What do I do instead? Well, I look around for another currency that's probably highly correlated with the krona. And since Iceland does most of its trade with the European Union, then most likely the currency that I should use is the euro. The dollar might be okay, maybe the pound, but you're probably better off with the euro because the correlation between the euro and the Icelandic krona is probably going to be very high, given how much trade they do with each other. If the economy slumps in the eurozone, then probably the Icelandic krona will weaken and vice versa. So that would be a good choice. The delivery date, if we can't find the exact delivery date, we typically choose a contract that matures later than the hedging date that we need. And cross-hedging, cross-hedging, by the way, if you're using cross-hedging means you're using a contract that is not exactly the same as your exposure. So when we use the a euro futures contract to hedge the risk of the Icelandic krona, that's an example of the of cross-hedging. And then it matters a great deal what the correlation is between the underlying asset that we really need to hedge and the one underlying the futures contract. So we can also use it as an example, the Swedish krona. Sweden never joined the the Eurozone. And so therefore, if we are doing business in Sweden, we may want to hedge our risk with a futures contract based on the euro. So now the last remaining question is, how many contracts do we buy or sell? So there's two approaches to doing this. The basic approach and the minimum variance approach. The basic approach says, listen, whatever, let's say your exposure to Swedish krona is $1 million worth of krona. Then you would buy futures contracts worth $1 million, end of story. If you're talking about pounds, for example, if you are going to buy 62,500,000 pounds in the future, we know that each contract is written on 62,500 pounds, then it would make sense that you buy 100 contracts. Okay, and that's fine. But for certain applications, especially cross-hedging, well, it doesn't work quite that simply. What you need to do is take into account, let's say we are using the dollar and the Swedish krona. We need to know the volatility of the exchange rate between the two currencies, the volatility of the futures price on the euro, and the correlation between them. And that will give us the so-called minimum variance ratio. All right, so let's see, we got a nice numerical example here. I threw this in here, lingonberry jam. I'm an importer, I'm buying lingonberry jam from Sweden. And I'm going to need to buy 100 million Swedish kronor in 3 months. And I've decided to hedge this position with a contract on 125,000 euros. Okay, now, the volatility of the exchange rate, which is the uncertainty associated with it, is 20% per year. The volatility of the futures price between the dollar and the euro is 15% per year, and the correlation is 0.82. What is the minimum variance hedge ratio? So when I plug in these numbers, it turns out that I need 1.093 contracts for every dollar of exposure. So for example, it's 1.093. This is what I need to finally, the number of contracts, not the number of contracts that I need comes from this formula. The H star came from this relationship. So what do we have here? So the optimal number of contracts is this minimum variance hedging ratio. NA is the number of units that I'm hedging, and QF is the size of a single futures contract. So let's say that I'm committed to buying 100,000 Swedish kroner. Each contract on the euro, which I'm using to hedge the kroner, is for 125,000 euros. The optimal ratio is 1.093. So I plug all these in. It turns out that the optimum strategy is for me to buy 874 euro contracts to hedge my exposure to 100 million Swedish kroner. All right, so to wrap that up, the number of futures contracts.
What does he mean, the contracts? Like what's in a contract?
Oh, a single contract written on 125,000 euros on the CME. Remember, we saw that the British pound contract is for 62,500 British pounds.
Okay.
The equivalent contract for euros is written on 125,000 euros.
So you're buying 125 times 874?
No, I just need 874 euro contracts to hedge my risk.
But each euro contract is one.
That's right, but I'm exposed to 100 million kroner. That's why it needs so many contracts.
Okay. Okay, yes.
So the number of contracts is determined by the basic approach or the minimum variance ratio. If I do not have the right contract available to me, I can find or engage in a cross hedge. Like I did here, I'm hedging my Swedish kroner exposure with euro futures. If there's no date available that works for me, I choose the one that's just past the date on which I will take possession of my kroners. For example, if I want to buy my kroners in August, the contracts that are available have maturity dates of June and September. I would pick the September contract. Okay. And so the last detail was the number of contracts, which proved to be 874. And again, it comes down to the relationship between the Swedish kroner and the euro and how many euro are there in each futures contract. So that's just a quick example of how you would determine how to hedge your risk with futures contracts when you're not really able to line up your particular situation with what's available in the marketplace. So this is a way we can sort of work around that. We can figure out how to hedge with euros instead of with kroner, and still hedge with futures rather than forwards. Okay, I mean, again, the advantage here is that no matter what happens, I'm not ever going to have to take possession of the kroner if I don't want to. All right, well, anyway, so I just realized now that that was the end of that. So next week, we'll be looking at swaps in much more detail. Now, the swaps are a little bit more complicated. They will require us to set up our examples in Excel, not like we haven't been doing that all along, but you know, it really lends itself nicely because you have a bunch of regular repeated cash flows and it'll make things much simpler. In fact, let me see. Yeah, they're here. Let's take a look at this swaps template right here. Yeah, you see what I mean? There's quite a bit of calculation going on here, but once it's set up properly, you'll see that it makes perfect sense. And when we're done with swaps, the following week, we can dive into options, which are by far the most interesting and complicated of all the derivatives. And we'll get to do a lot of hedging strategies, a lot of trading strategies, a lot of pricing strategies. So it will be very interesting. But next week, we'll be looking at swaps, which are the newest of the derivatives. They've only been around since the early 80s, and they came about out of necessity, almost by accident. So, all right, anyway, so it's a little early, but we can stop here and I will send you all this new material. And you can keep working on last week's assignment if you want to. There's a second one. And I'll also make sure you get your hands on these notes we've been working on all night. And you should be all set. All right.
Could you send the PowerPoint with the notes today?
Yes, I will send everything we did tonight.
And also, I'm sorry, can we do another example with the like the homework?
What about the homework?
Can we do another example like number 1A for the homework?
All right.
with the formula.
You mean this one?
Yeah, with the FOSOER.
Yes. So that's going to be. Oh, that's this one. That is this one. It's
Yeah.
just that I use different numbers, that's all.
Mhm.
So in other words, this is what you need to do for question 1, right here. In fact, you could literally just use this as a template and just substitute the new numbers.
Okay. So why does it say like, the US 6-month rate of interest is 1% and the UK 6-month rate of interest is 2%?
Right.
Because they believe that inflation in the UK, it's like go faster?
Oh, no, most countries have different interest rates. It's very unusual that rates are exactly the same in every country.
But what kind of interest rates are those? Like borrowing rates?
Yes, these are actually deposit rates. These are the rates that you could earn by holding what are called euro currencies, meaning if I wanted to hold American dollars in a British bank account, they are referred to as euro dollars. And there's a rate of interest that they earn, which is similar to what you get in the United States, but it's maybe a little bit different. And so these they're really deposit rates, but we usually use these interchangeably. In these simple examples, we don't always make a distinction between the borrowing and the lending rates, just because the principle is exactly the same. So while these are technically deposit rates, they will work very well with these formulas because they're considered to be risk-free in the sense that if I hold euro dollars with Barclays in London, the chances of them defaulting are basically 0.
So if I put dollars in London and Germany, they're always gonna pay me 1%?
In
On
this
this-
example,
on this-
yes,
yeah,
if I'm holding euro dollars in any country except the United States, I'll get 1% per year.
Oh, okay. And then I use the SO formula to calculate.
Yes. Right, that's this one. Yeah, right there.
Yeah. Okay. Wait, that's
It's pretty straightforward.
that's. oh, Okay.
Yeah, and
And
you can
then
just,
for question B, that would be the rate to calculate the. That's assignment 2. In assignment 1. So for question B, we use that rate to calculate.
yeah, I mean, you've locked in the rate that you're going to pay for the pound, so the spot price is irrelevant. Whatever you've calculated in part A is the answer to part B
Right.
as well.
Okay. Okay, and then on 3, what kind of graph is that? Like the
Oh, let me show you, based on last
corner
week.
graph?
Hold on, we've got plenty of examples. Let me go get them. That would be in the middle of, or towards the end of the chapter
Which chapter 1?
1.
Oh, like.
I'm almost there.
Like this.
These types of graphs right here. You see how I've
Yeah.
got, that's what we need.
All right. But so on that example, they're only swapping LIBOR, but the rate was LIBOR plus 5%, right? In that particular.
Yes, they have to tell you, like here, for example, the dealer will pay us 4% for LIBOR.
So, but this, okay, so then when I do my graph, I'm not gonna put LIBOR plus 5% and then 4% plus 5%. I'm just gonna do, because they're only swapping LIBOR for 4%, the LIBOR.
Right, exactly.
Yeah.
The
The
cash flow.
5% is not included in the graph, right?
Right. So, but the loan, which you would
It's
normally
LIBOR
see
plus 5.
down here, yes, exactly. The trade between the dealer and the other party is going to be LIBOR for 4.
Okay. All right. Okay, thank
So it's
you.
just like this diagram.
Okay.
I think it'll be okay.
Seems like there was much more
Oh, okay.
complex content way.
No, that's all it was. All right. So any last minute questions? All right. I guess I'll see you all next Monday then.
Thank you.
All right. Good night.
Thank you.
Bye.
Hey, Alan, I actually just have one more quick question.
Oh,
about
sure. Go ahead.
Assignment 1.
Uh-huh.
So for question 1, part B, are they not asking what the current price of the underlying asset is when they're given the future spot rate at 6 months of 1.35?
Well, the thing is, it's a bit of a trick question because the idea is that when you enter into the forward contract, that's what you'll pay in 6 months, regardless of the spot rate.
Gotcha. So just very quickly, the way that I approached this problem was that I put the 1.35 amount as where the future amount would be, and then I backed into what the current present value price is going to be. Is that not?
No, you're overthinking it.
Okay.
Once you've locked in that forward price with the contract,
Yep.
that's what you're going to pay in 6 months.
Gotcha. Okay.
All right.
Yep, that makes sense. Thank you.
Excellent. All right. See you next time.